In this video, I want to take you through and I want to show you how to park your money. Now, what do I mean when I say park your money? A lot of times as traders, we have a lot of money sitting over in cash. Now I'm going to come over here and of course, this is our demo account. We built this thing up to over $1 million. But the point is that we've got a bunch of cash sitting here and it's not in the market. All right, it's got a lot of cash that's not in the market. So what are we going to do about this money that's not working for us? Now, of course, we're having it sit there because we're looking for an opportunity. We're waiting for a buy signal of some sort that we can put some of this money into the market, right? And we can just kind of spread it around and put money into the market and have it working for us and making us some money. But in the meantime, what about the money that's sitting there in cash? Maybe you don't have $1 million account, but maybe you have a $20,000 account or a $10,000 account or even a $25,000 account, which would avoid the pattern day trading rules, right? So we've got a $25,000 account, but we've only got maybe 5,000 of it invested in a couple of options. So that's leaving $20,000 sitting out there. It's not working for us. It's not earning any interest. I mean, it'd be better off sitting in a bank earning 0.5% interest than sitting in our investment account, right? Sitting there earning nothing. So there is a way that we can take some of this money and we can park it into an interest-bearing account. If you want to think about it like that, we want to think about it kind of as an interest-bearing account and have it earn a little bit of money for us with very low risk. Okay, we're willing to take risks. We know that trading in the stock market is risky, right? That's why we're here. You know, little risk, little return. That's why if you put it in the bank, you're going to get 0.5% or 0.25%. There's no risk over there, but you're also not going to have any reward. So you bring it into the stock market where you know you're taking greater risk. So there's always greater risk in investing in the stock market, but we also want to take very little risk with the money that we're parking. As little risk as possible because we want it just to kind of sit there, collect interest for us while we're waiting for a better opportunity to come along. We can then liquidate it, sell it off, bring it into a different opportunity that might give us a greater return. So in the meantime, let's do this. Let's come in here, and I'm going to come into the queues, and we're just going to park it in the queues. Now, this is how you can park some of your money in the queues. Now, a lot of people will say, well, I'm just going to index my money. You might have heard that term. Oh, I'm just indexing my money. What does that mean, to index your money? Well, that means you're going to take it, and you're just going to put it into an index fund or into the Qs or the diamonds, which is DIA, or you're going to put it into the S&P, and you're just going to index it, okay? And that means we're going to come in here. Let's say we're going to come in with 100 shares and we're just going to index. That's $27,000. We're just going to go ahead. We're going to buy the market and we've just indexed $25,000 or $27,000. Okay, so that's what indexing means. Now, the risk of this is that we're going to come in here and let's say that the market falls. If the market falls, well, you know, if it falls down to here, you lose $2,700. And if it rises, well, let's see, do we have, yeah, we have 100 shares. So if we come in here and the market rises, well, you're going to make, you know, $1,900, let's take it up to about the same, $2,700. So you're going to make $2,700 if the market rises, but you're going to lose $2,700 if the market falls. So that's called indexing your money. And it's no fun to be in a situation where your money loses, you index your money and suddenly the market falls and you lose a bunch of money. Now, had you indexed back here and the market rose, well, great. You'd have been in great shape to have indexed your money coming up out of this big fall from the coronavirus, right? But what about now? You want to kind of take your money out, put it back in, take it out, put it back in, so that you can, you know, put it into better opportunities, like maybe buy some options if the market starts to break above a certain level of resistance or something on Apple, and you think that would be a great opportunity. But in the meantime, your money's sitting over here in cash. It's not making you anything. So you could index it, and this is what we call indexing, just by throwing it into one of these ETF Qs or diamonds or S&P. The problem is that you've got the risk of loss, right? If the market falls, you could lose some of it. You could lose a large percentage of it. But there is a better way, and you know, I think it's a better way. In my opinion, there's a better way. So let's come in here, and we're going to use options to index our money. In the same market, we're going to index them in the Qs, but we're going to index them with options. And so we're going to come in, and I'm going to come down here to the options tab, and we're just going to start looking for an opportunity to index some of our money into the Qs using options. And I'm going to show you a little bit of a difference between using options to index versus using you know, just indexing straight into the market with a position. So let's come in here and use an option. And the first thing I want to do is I want to find out where all the big banks are, all the big traders, where everybody's at, all the volume and all the open interest. When we're looking out here, and right here, let's see, well, let's go to 10 days and take a look. And you can see the volume and the open interest on the 10-day options, that's pretty good. It's not too bad. That's pretty good. What we want to look for is we're looking for volume to be above 100 and open interest to be above 1,000. That's kind of the baseline, right? We want to kind of do that. We want to kind of find something in that range. And these are easily falling within that range, but it's only 10 days. And we want to index our money for longer than 10 days. So let's come out here. Let's look at 17. Now, could we do 17? We could probably find something in there, but that's not the best. Let's come out here a little bit further. Let's come to 24 days. And what are we looking for? We're looking for, large volume, large open interest. We're just trying to kind of find where everybody's at. And right here, 24 days, nobody's there. Pretty slim pickings right there for the Qs on 24 days. Let's go to 31 days. Oh, goodness sakes, look at that. There we just found the gold mine, right? That's where everybody's at. It looks like everyone's on the 31 days. Big numbers there. Let's go 38 and see what they look like. Ooh, nobody's there. Pretty quiet. 43 days. We'd like to go out to about 45 days if possible. 45 days, kind of that magic number for us. But nobody's playing at 45 days. Let's go ahead a little bit further. 59. 59? We could do 59. 59's okay. We could get some good stuff in here at 59. There's some players there, but I think I like that 30 days. That 31 days looks pretty good to me. We got some players in here. So let's come in and play with the 31-day options, okay? So that means we're going to index our money for 31 days. And here's how we're going to do it, using options. We're going to come in and we're just going to do a bullish credit spread, okay? It's very simple, bullish credit spread. We're going to drop that money in there. And if you look at the calculator over here, this is the important thing to consider and to take into consideration. Now, we're very close to the money right now for indexing. We don't really want to be this close. This is really super close. So I'm going to bring it way out here, and we're going to look at the probability of being out of the money. And we want to take this thing out so far out of the money that there's a very little chance that the market's going to fall down there and touch our position in the next 30 days. So we're going to come down here, and I'm just going to slide it down here. I'm going to go all the way out to 90, and I'm going to bring both the sell and the put all the way out to 90. And we're going to start at 90. We might go different. We might go up. We might go short. But look at where that's at on the market. So right there, you can see that we're indexing our money. If we bought and sold a credit spread. Now, what this is doing is it's saying that right here we're going to sell the 247 put and we're going to buy the 246 put. And you're like, well, why would you do that? It's so close together. Credit spreads are generally, don't we put a big gap between them? Well, you can, and it's pretty traditional to do so. But let's look at the math and see if that's really realistic to do. So as we come down here, we see that we have our probabilities of being out of the money. And I'm just going to put that one that we're going to sell right at 90%. And this is our the one that our insurance policy. Okay, so we're going to sell it, and we're going to collect $134 for every one that we're going to sell. So we're going to sell it and collect $134 for a 246 put. But we need to buy some insurance. So the insurance policy down here, this is $103. Now the idea is that the further away, the less the insurance policy, right? But the more money you have to pay in the what we call the deductible. So if you're buying an insurance policy, you have a deductible. And deductible is the amount of money between where you sell your option right in here. So we sell it here and we buy the insurance policy down here to protect us against the market falling. So if we look over here at the calculator, notice what we're going to do is we're going to have a trade premium credit of $51 and our margin requirement of $900. So that's a return on our risk of 5.67%. That's roughly 5% interest, or almost 5.5% interest on our money in 30 days. That's pretty sweet. 5.5% interest on our money in 30 days. And so we're putting $900 with quantity one into the market, indexing it, and we're going to get a return of 5.67% in 30 days. That's a premium credit of $51. So you're going to put $900 into the account, and in 31 days you're going to get $51 back. That's better than sitting in cash, right? It's better than sitting in cash, not getting anything. Now, if you were to annualize that, that's over 55% interest, and maybe even a little bit more than 55% interest on your money. 55% interest on your money. Let's say you go to, Bank of Utah. That's where I live. And say, hey, Bank of Utah, I want 55% interest on my money if I put it into your account. What are they going to say? They're going to laugh their heads off, right? They're not going to give you 55% interest on the money. That's pretty good. Well, what's the risk? Well, the risk is that the market could fall below that red line and you would end up losing your $900. But what's the chance of that? Well, we know the odds. We can come down here and look at the odds. The odds are 90% that it's not going to happen. Probability of being out of the money, 90%. Now we've got a $900 margin requirement there. That's our risk. That's our insurance policy. Well, why are we doing that? Why is that so far away? Let's bring that closer. Let's make a smaller margin requirement. Let's bring that insurance policy all the way up to right next to it. So now what's our insurance policy? Look at that. Return on risk is now 7% with a margin requirement of $100. Holy cow. We just dispelled a great rumor that you need to have your insurance policy a long ways away from the actual purchase or sale of your put option, right? Look at that. The put option is a 90% probability of being out of the money. We've got our insurance policy way down here with a great big deductible. Margin requirement $900 to get a 5.67% return. Well, watch this. We can get a higher return on our money. Look, we're getting a 7% return with a margin requirement of $100. And you say, yeah, but it's only $7. It's only $7. But that's $7 on every $100 that we put into or index into the Qs. Does that make sense? Look at this. We bring this apart just a little bit. What does it do to us? Nothing. It makes our margin requirement go up to $200. Our trade premium credit is $14. Now we're at $7. Ooh, look at that. We go $200, 7. We're getting $14 at 7, $200. There's no advantage. There's no advantage. We get $14, but we have to put in $200, so it's still the same return on risk, $7. Everybody focuses on the dollar amount, and that's the wrong thing to do. If you focus on the dollar amount, you can say, oh, wow, look at this, big dollar amount. I can make $58, but it's only 5.27% because you have to have a bigger margin and a bigger risk, right? So if we put that right up next to it, look at that. We can get a 7% return on our $100. On every $100 we're indexing into the market. And the market just has to stay above our red line for us to collect that in the next 30 days. If the market falls and crashes down into here, well, of course, we could lose our $100. If it falls below that red line, we could lose our $100. That's the risk that we're taking. But if you indexed into the market, look, you would use your 100 shares, your long 100, and remember, each one option represents 100 shares. You would lose $2,700. Of course, if the market went up, you'd make $2,647, but that's the risk. You're not using the Qs in this case. You're not using the Qs as an investment. You're using it as an index or as a place to park your money. And you just want to collect interest. Now, you could do this month after month after month after month and just stay a long ways away from the market, index your money, and collect 7% interest on your money, every 30 days. Now, that's, again, 7 times 12. That's over 70% interest on your money, and all you have to do is just, you're gambling that the market's going to stay above the red line to collect that 7% interest. Now you say, well, I don't know if the market's going to stay above that red line. What would it have to do to fall below that red line? If you indexed it into the money and it fell, you're going to lose the money anyway. In fact, you're going to lose more, right? You're going to lose a lot more. You're going to make a lot more if the market runs, but that's not the investment we're looking for. If we want to go and invest in something else, we're going to use an option on Apple or an option on Microsoft or something like that, and we're going to make some money. We're going to actually go in and invest and do this. This is for indexing. This is just for the money that we have sitting in this side. And you might think to yourself, oh my gosh, I could just do this and not have to worry about anything else. I could just collect 7% or, do this and just leave this money in there and collect 70% interest on my money every month after month after month. And this is what I do. I just leave a lot of money in here, and then when I need it, I pull it out of here and go over and put it in something else. And you could even go on a bigger risk. You could come in here and say, well, I think the market might have a chance of falling down there. Okay, well, pull your money further away. Okay, give yourself a bigger margin here. Just pull it in, and there we go. Now we're out here at 96% chance of having this market not come down. Look how far the market would have to fall before you didn't get your, in this case, 2% interest. Now, 2% interest on your money in 30 days is still 2 times 12. 24% interest on your money. That's pretty darn good. 24% interest on your money in 30 days. I mean, that would be annualized, so 2% interest on your money in 30 days would be 24% interest annualized. If you're happy with 24% interest on your money, then you could do this day in and day out every 30 days, park your money into the Qs, and just make sure you're far enough away that you don't anticipate that the market's going to fall all the way down to here. Now, if you were to index your money again and the market fell, you'd lose that money anyway, but you're making a whole lot more if the market goes up. That's the gamble you're taking. Okay, in this case, we're just happy to take our $2 on every $100 we put into the market, or 2% interest for every 30 days. Again, about 24% interest annualized. So if we come in here and we want to do that, or let's come up, maybe we can look at the market and do your little technical analysis and think, well, in the next 30 days, what would the market have to do to fall that far? Let's come back and see how big of a move that is. From here to here, when was the last time the market fell like that? Let's come over here and see what that would take. That would have to be almost a corona. For the market to fall and collapse that far would have to be almost what happened when we had the coronavirus breakout. Okay, that's how far that market fell. Take that into consideration. If the market fell that far, you could lose your $100. All right? So here's the other idea. The idea is here that if this market falls, you don't necessarily lose your $100, because whenever you sell an option, what that means is you're telling the market that you want to buy the Qs, in this case, at this price level. Okay, so if the market comes down here and it actually falls below that red line, are you going to lose your $100? Yeah, you're going to lose your $100, but you're going to also have the opportunity. You can own 100 shares of the Qs at this price level, which not a bad price level to be owning the Qs. All right. Whereas if you just own the shares, well, if you had the shares and the shares fell down, well, you would lose that much money. $5,000 in this case. For every 100 shares that you own, you'd lose $5,000, but you would own the shares at this level. If you do it this way, if you index your money this way using options, you would lose $100. You would still have the same number of shares. You'd have the shares down here at this level, and you would not have lost $4,800. You would have lost $100, and you'd still own the shares at this price level. The difference is the amount of money you're going to make if the market rises or falls. It doesn't matter. All it has to do is stay above that red line. If the market stays above this red line, anywhere it goes in here, inside that market, that's the rule, that's the game right there. Anywhere inside that box, you get to keep your 2%, or $2 on every $100 you put into the market. So this is a nice, safe way of doing, safe. Again, in the context of the stock market, this is a very nice, safe way of indexing your money into the Qs, into one of these ETFs. Now you say, well, Lan, I can take a little bit bigger risk than that. I don't think in the next 30 days the Qs are going to fall below maybe this level here. Okay, so you say, okay, that's the level. So well, then you drag your orders up there and put them where you want them, where you think you can get a little bit more interest on your money. And there's that level right there. So we can come in, and now we're going to look for open interest and volume and say, oh, this is where everybody's at. We'll put it right kind of where everybody's at, so we can get in and out of the market pretty easy. And again, we can move that insurance policy around and see where we're going to maximize our profit potential. So we're going to have a margin requirement of $100 with a 5% return. So what happens if we go one away? Well, we go to a 200% margin at 4.5% return. It's more money, $9, as opposed to what we have up here, which is $5. But I would rather have the higher percent interest rate return, 5%, as opposed to the 4.5%, because our margin increases to $200. So now we put that right there, right next to each other. And we have the 5% return. Now remember, this is 5% in 30 days. 5% annualized, 5 times 12, that's over 50%. That's almost 60% interest on your money annualized. So that's not bad. That's something that we can do by putting our money somewhere and park it over here, have it working for us, so that when we are then having an opportunity to come and find something else we want to put our money at a higher risk and a higher reward, we can move our money out of here. So how do we do this? Well, let's come in here and we just decide how much we want in there. We just say, well, at 5%, I'm going to buy 100 of these. That's why we need to have a large open interest and volume. We need to be able to have somebody over here to play with. So we go in there and say, okay, trade premium credit. We're going to collect $400 on our investment of $10,000 with a return of 4%. So it's going to be 4% interest on our margin requirement. We call that a return on risk, because we're going to put $1,000 into the market. We're going to collect 4% or $400 over the next 30 days by just letting that money sit there indexed. And as long as the market stays above that red line, we get to keep our entire $400. Now, it doesn't matter if the market falls, rises, whipsaws around in there. It doesn't matter. You're going to collect your $400 as long as at expiration it's above the red line. That's the corner right there that you're worried about. As long as the market's above that red line, it's got to hit that purple line first. You're going to collect your entire 4% interest, or $400. Now, if it falls below it, well, then you're going to lose your $1,000. You're going to lose your $10,000 because in this case we're putting in 100. We're buying 100 of options. You're going to pay $10,000 to have your shares at this point. You're going to end up buying your shares or owning your shares at this point. That's what you're going to do. Okay, you're going to own your shares at this point. So that's kind of the risk. So you want to say, well, I'm going to buy 100 options, which is 100 options times 100 options represents 1,000 shares. So you're going to have 1,000 shares of the Qs at that price level if the market falls below that level. And then you can decide if you want to hang on to them and let the market rise again, or if you want to liquidate them at that part and take your lumps as you would over here if you had indexed straight up. Okay, so that's the risk you're taking. So we can come in here and let's just for fun change this over, come to our preferences, and that would be 1,000 because that's what we're comparing, right? Apples to apples. Oh, actually that's down here, so we have to come up here. We lose $37,600. So you're going to lose, if you index straight up, you're going to lose $37,600 if the market comes to here, and you'll still own your shares, right? But you will have lost $37,000. In this case, you would have lost $10,000. So the market falls all the way down here to the red line. You'd lost $10,000 instead of $37,000, and you'd still own the shares. You would own the shares at this level right here. But if the market doesn't fall all the way down there, if it stays above, even if it falls down 1 penny above that red line, if it falls all the way down here, you still get your $400. Okay, you still get your 4%. So that's the risk you're taking. And that's the comparing apples to apples, kind of the indexing it straight up versus indexing it with an option. If you index it with the option, you lose $10,000 if it falls below that red line. But you get to own the shares at that red line. If you'll index straight up and it falls all the way down here to the red line, you lose $37,600 and you still own the shares. What you're giving up is the growth potential. If that market rises and continues to rise and comes all the way up to here in those 30 days, you could have made $2,647, but instead you made $400. Okay, so that's the risk you're taking. That's the game. But think about it this way: you're indexing it, you're putting it into a savings account. You're not really looking at this as a long-term investment because there's many more opportunities out there that you might want to do that with instead of the Qs, and you don't really care if it rises or falls. You just don't want it to fall big time below that red line.